tax considerations in selling a business. We'll caveat this video that we are not CPAs, we are not accountants. For your specific transaction, please do confer with your CPA, with your accountant, and with our transactions as well. Our clients will bring in their CPAs or trusted advisors on the tax side of things, or we will bring in someone from our relationships as well at the opportune time within the transaction. That being said, in every single conversation that we have contemplating a potential exit or sale of a business, the tax implications are part of it. And so it's worth discussing here today is if you're selling a business and there's going to be a gross amount of consideration paid for the business, what portions of that are subject to taxes, what types of taxes, and really, how do you think about what you'll retain from the proceeds on a post-tax basis? And so a business can be acquired typically in two ways: through the acquisition of the assets of the business and certain liabilities, or through the purchase of the shares of a company or the stock of the business. And so you can think of that share purchase in kind of the traditional public market sense of buying a share of a stock and buying all of it. The vast majority of transactions in the middle market and the lower middle market that we're involved with are going to be asset purchases. And therefore, for purposes of the tax conversation today, we'll keep that limited to asset purchases. And so think of it conceptually as if you were selling a business that you own the entity and that all of the assets that are contained within that entity, as well as some of the liabilities, will be transferred to the new owner, the acquirer, and in exchange for that, money or consideration will thereafter be placed into that entity. And given these are typically LLCs or S corporations, the tax implications are effectively then passed through to the ultimate owners of the business. And so when looking at the asset purchase of a business, the buyer and seller throughout the process, and it's a negotiated point, something that we work on with our clients, is the allocation of that purchase price. And so if X dollars is being paid for the business via an asset purchase agreement, that APA will include an allocation of purchase price. And so in the assets of the balance sheet, there'll be an allocation of what purchase price or what piece of the purchase price is being correlated to what assets. And therefore, that's kind of how the taxes are recognized on a post-transaction basis by the seller. Think of it very, very broadly. You can think of a business as owning FF&E, so furnishings, fixture, and equipment, inventory, and you could say there's post-transaction transition obligations or non-competes. And then lastly, it's goodwill. It's how much the business is valued beyond purely just its hard assets. Now, there's obviously other things that go along with this. Most businesses are acquired on a cash-free, debt-free basis other than net working capital, and the calculation of net working capital is something that we can discuss in a different video. But if you think of those broad categories, each has its own tax implication. And so FF&E, think if you own a big manufacturing company, think of all the machinery, the racks, all of the physical, tangible items of a business, not including inventory. Those are typically taxed at ordinary income. The reason being is when you buy them, you are able to depreciate them over time. And therefore, if you sell these assets or this FF&E, you'll only be taxed at the ordinary income rate beyond the non-depreciated basis. And so basically everything you haven't depreciated for that FF&E will be taxed at an ordinary income rate because you've already gleaned the tax advantage of the depreciation up to that point. Inventory, on the other hand, given it's been purchased with after-tax money, is not subject to tax. So the inventory in a sale will be, if you have a distribution company that keeps $2 million of goods at any given time, and you sell the company for $10 million and $2 million of it is represented in the inventory, that portion of the purchase price, if you will not be subject to tax. Now, you can make the argument that all money spent in a business is post-tax money, and we can get into tax debates, but for purposes of this conversation, that's the treatment of inventory. Next are kind of post-transaction implications. And so whether it's non-competes, whether you're being paid for some transitionary period of the business, other things of that nature, those are going to be taxed at ordinary income rate, given that they're tantamount to a 1099 contractor being paid or a salary you can think of, and that's kind of how that's treated in most situations. And then lastly, and the biggest component of a transaction is goodwill. So that is the value being attributed to a business beyond its tangible assets and beyond other agreed upon, call them restrictions and obligations post-transaction. The value of that is goodwill. So if a company is being purchased for $10 million, there's $1 million of equipment, there's $2 million of inventory, and say there's another $500,000 obligation on a post-transaction basis for the sellers, that would be $3.5 million. Then the $6.5 million, or the balance of the transaction, would be subject, or would be goodwill, and goodwill subject to long-term capital gains rates, which is meaningfully less than ordinary income, which is taxed at a lower rate than ordinary income. When you think of the sale of a business and what is the likely retention of proceeds post-tax, you can think of those broad categories. Now, obviously, certain industries have different considerations and will have more of these things than others, right? If you think of a software company versus a manufacturing business, a relationship-driven consulting firm versus a large distribution firm, but this is the general breakdown from a tax implication. You have FF&E at ordinary income on the non-depreciated components, inventory tax-free, post-transaction obligations and restrictions are ordinary income given their similarity to a salary, and goodwill, which will be long-term capital gains. Now, in every transaction, there's going to be a conversation around that purchase price allocation. Sometimes the buyer will propose it, sometimes the seller will propose it, and it is a negotiated component because there's certain depreciation step-ups for acquirers that they want. Goodwill in transactions is typically depreciated over a 10-plus year basis for the acquirer, and therefore, if it can be allocated towards certain equipment that has a shorter depreciation schedule, they can glean better depreciation or quicker depreciation. And from a seller's perspective, obviously, they would want to allocate more of the transaction towards the lower tax considerations as well. Now again, we will end with the same caveat that we began with, that CPA will be the best advisor for these considerations at the right time within a transaction. However, given how often this question comes up, it's a good item just to keep a general framework in mind as to the tax implications of proceeds for the sale of a business, and that's what we wanted to accomplish today. Hope the week continues to go well. Keep pushing forward. God bless. We'll see everyone next time.